All right, welcome to Maner Costerisan's nonprofit 9 Topics in 90 Minutes webinar. We're so glad you all could join us today. We are going to be going over a variety of topics and sharing valuable updates and considerations for your nonprofit. A few housekeeping items: this session is being recorded and everyone is muted. If you have any questions, please type them in the chat function. We will have time at the end to answer some of those questions. You can also receive continuing education credits and professional development activities by attending this webinar. Our nonprofit community is so excited to be here today, so thank you all for taking the time to share your knowledge. I'm going to turn it over to Rebecca, who's going to go over some CPE details.
Good morning, everybody, and welcome to the webinar. I'm looking forward to it and I hope that you are too. If you are needing the CPE credit or the continuing professional education credit for today, please make sure that you answer the polls that pop up periodically throughout the program and attend at least 50 minutes of the program. 50 minutes is equal to 1 credit hour. And since we're going at 90 minutes, we hope to have just over 1.5 credit hours for you today. So make sure you get 75% of those attendance polls and look forward to seeing you at the end.
Thank you, everybody, for attending. I'm Brandy Makula, and I am a tax partner here at Maner Costerisan. And I'm gonna, we have a lot of things to get through today. The agenda is on the screen right now. We're gonna go through the 9 topics in 90 minutes. So each of us have about 10 minutes. So we would ask that if you have any questions that you put them in the chat function in Zoom, and we will try to get to those at the end of the presentation, or we may be able to answer them through the chat function throughout the time that we have here. So I am going to start off today talking about lobbying and PAC filings with nonprofits. So if you can go to the next slide. So first I want to start off just talking about, there's multiple different types of organizations that we do. So we have public charities, private foundations, and then there's lots of other nonprofit organizations, but for today's purpose, we're going to talk mostly about 501c4 and 501c6 organizations, since we see those more commonly. And we're going to talk about the tax rules for those. So just in general, since we have 10 minutes, in general, you can go into a lot of details on this, but in general, for public charities, lobbying is permitted if it's not a substantial part of the organization's total activities. We'll talk about what substantial means in a minute. And you absolutely cannot have any political campaign activities at any level in a public charity. For private foundations, lobbying is not permitted. And if it does happen, it could be subject to excise taxes. They may fund charities that do lobbying, because we all know private foundations grant make, but grants cannot be earmarked specifically for lobbying. And no political campaign activities are permitted at any level. Now, for 501c4 and c6 organizations, political activity is allowed if it's not the organization's primary purpose. And we'll talk a little bit later, if it does become a primary purpose, it might make sense to be a PAC. Unlimited lobbying permitted. This is allowed. However, there are some reconciliations on how dues are coming in from the organization, from the members, and what piece of those dues are non-deductible because they're spent on lobbying, because lobbying and political activities are non-deductible. So also an organization in that 501c4 c6 area could elect to pay a proxy tax rather than making some of their dues non-deductible. Next. So when we're talking about a charity and lobbying, so in general, what is lobbying for a charity? It's the attempt to influence legislation at like the federal, state, or local level through direct or grassroots activities. So this is not going to include activity that supports or opposes the election of candidate for public office. That's going to be the political piece to it. So you can still educate and influence certain types of legislation that might affect your organization. So back when I talked about substantial, this is where we get into that. So as a charity, there's 2 ways. One, which I'll talk about first, the no substantial part test. That's very vague. What does the IRS deem to be substantial? We really don't know. And so it kind of leaves it a little bit open on how much you can spend on that lobbying. Now, there's also a 501H election that you can do. You can make the election with the IRS, And what it does is it looks at total expenditures of the organization over a rolling period of time. I think it's 4 years. And it gives you a cap. So then you know exactly you could spend up to this amount on lobbying without getting in trouble, I guess you could say, from the IRS. And so it gives you that bright line test that can help guide that lobbying. I usually recommend this if an organization is starting to increase their lobbying expenditures. If you're a charity and you don't really do a lot of lobbying, it's not necessary to do this, but we can always look at that depending on what those levels of lobbying are. And like I said, no political campaign activities are permitted at any level for a C3. Next. Now with your C4s and your C6s, lobbying can be much broader of a definition. And there's pages and pages of definitions. So we're not going to go through all that today, but it can include influencing the general public on elections and legislative matters. And it can include participation in any political campaign on behalf or in opposition of candidate. And then political campaign activity is supporting or opposing the election of a specific candidate for public office. General rules for these types of organizations: political activity cannot be their primary activity. Like I mentioned earlier, typically if it's primary, the organization should either be a IRS Section 527 organization, which is a political action committee, or they can create another organization, which we see a lot, that they kind of funnel the political activity through. Lobbying is non-deductible. So typically the dues that a member will pay to an organization, the organization will have to put something on notice, give notice to those members that a piece of their dues are non-deductible. And that is determined based on how much of those dues are spent on lobbying. We do have there's some clients out there that elect to say your dues are 100% deductible, and they elect to pay a proxy tax instead, which that is taxed on the 990T at a rate of 21%, the same as any other corporate tax rate. And also on a C6 or a C4, if you do get into political activity, say you donate directly to a political organization, or you're doing political type activities, then you may have to file an 1120 POL. Next. I'm going to just dab in a little bit on the 527 Political Action Committee. It's usually just a organization that solely does political activity. You must give initial notice to the IRS that you're going to file as a PAC, and then there's some annual filings that you may need to do. I did include a website on this slide that you can actually look up. A lot of organizations have PACs that they don't even know if they have filing requirements or that they even have documents. So if you as a client or you as someone in the office who knows that the organization has a PAC, we should probably start looking at that to make sure that we're not missing any filings. Next. Sometimes organizations can use a related tax exempt org to funnel that activity, as I mentioned earlier. So a 501c3 may create another entity to do that and then have that unlimited lobbying. C4s or C6 sometimes create PACs that they can funnel that activity through. But just be conscious when you're doing that with activity that's going between those organizations, and make sure you talk to us to make sure that we're doing that accurately. Next. Possible filing requirements, like I mentioned earlier, charities can possibly have that 501H election or some Schedule C reporting, which is done on the Form 990 to show those lobbying activities. Same with C4s and C6s. We're going to have just some reconciling of dues on Schedule C, possibly a POL requirement if there's political activity. And then what some people don't realize is the 527 Political Action Committee has two different filing requirements. They could have a 990 or they could have 1120 POL. And a lot of times these PACs have very little activity in them. And then one year they'll have a large amount of activity. So we like to track those PACs to make sure that that we're meeting the filing requirements. In additional notes, e-file is mandatory for all 990s. PACs that may have not had a filing requirement in the past may in the future. And we really want to make sure we get those set up and e-filed early in case there's any rejection issues. And some packs are very old and have little documentation, so it's very important to start gathering that documentation and making sure that we're tracking those organizations. So please let us know if you do. And I think that's it for me. And I think we're going on to Aaron next. Thank you.
All right, thanks, Brandy. Trying to share my screen here. Thought we'd take us a couple of minutes today to talk about contributions compared to contracts with customers and how their accounting treatment differs. So the FASB, the Financial Accounting Standards Board, issued Accounting Standards Update 2018-08 in June of 2018, with the effective dates beginning in 2019. So from this slide, you can tell there is nothing new here that I'm going to be going over today. This is just a refresher. And by the way, there really wasn't anything new when it was issued in 2018. It is a standard that simply clarified existing accounting guidance. So if it's not new, or if it wasn't new, why do we need it? Why was it necessary? This all started with the issuance and the implementation of the revenue recognition standard. So the revenue from contracts with customers standard ASU 2014-09, which we commonly refer to as the revenue RevRec standard. The idea behind the revenue recognition standard is to recognize revenue as performance obligations are satisfied. For example, if a member of a trade association pays annual dues that include a subscription to 12 monthly trade magazines, in that instance, there are 13 performance obligations and 2 separate revenue streams. So revenue would be allocated between membership income and publication income. The portion of the dues payment attributed to the magazines would be recognized as each issue is published, and the remainder would be recognized ratably over the membership period. So that's what really started the need for this clarified statement, because there was questions about grants. You know, what do we do with grant contracts, grant agreements? And how does that revenue recognition standard apply to grants, particularly governmental grants? And there was a lot of diversity in practice as to how government grants were being accounted for. It really brought to light that even the existing accounting standards were not being applied correctly. So ASU 2018-08 defines how to characterize grants and similar contracts with government agencies. It also defines conditions and explains how conditions are different than restrictions. So are government grants exchange transactions, such as a contract, or are they contributions? And the answer is it depends. So it comes down to commensurate value. Who is receiving the benefit from that payment, that exchange of assets? Is there a commensurate value to the government in a government grant? What is the government getting in exchange for that contribution or that asset transferred to the not-for-profit organization? If there is an exchange transaction, the accounting treatment follows topic 606, which is the RevRec standard. If it's a non-exchange transaction, the accounting treatment follows topic 958-605, which is contributions. And so the ASU 2018-08 does include a decision tree or a flow chart to help with the determination of which accounting guidance to follow. It all starts again with commensurate value. Is it an exchange transaction? Does the government receive anything in return for the assets or resources that they provided? And typically that's cash. So it's important to note that the indirect benefit received by the public as a result of the assets transferred to the not-for-profit organization is not the same thing as commensurate value. So if there is some societal benefit that the government is receiving, that's not really commensurate value for the exchange of the assets that they're providing to the not-for-profit organization. That's an example of commensurate value might be a not-for-profit organization conducting research and the government retaining the rights of that research, the results of the research. The not-for-profit is providing commensurate value for the payments received from the government, and that would be treated as an exchange transaction. They'll follow the revenue from contracts with customers accounting guidance in that example. Without the exchange of commensurate value, government contracts should generally be considered contributions and follow the contribution accounting guidance. There is a scenario, it's on the slide there, where a transaction may be part exchange and part contribution. That is covered elsewhere in the accounting guidance and really outside the scope of this brief overview. So if you have a contribution transaction, there are some additional questions that need to be asked. Is there a condition to receiving or recognizing the contribution as revenue? Is there some barrier that must be overcome? A contribution imposed by the donor includes a barrier that must be overcome, or excuse me, a condition imposed by the donor includes a barrier that must be overcome before a recipient is entitled to the asset transferred or promised. So the agreement, the governmental grant agreement, must also give either the contributor a right of return of the assets that is transferred or the promise of a right of release from its obligation to transfer the assets. So if there's a condition on the contribution and that condition is not met or until it's met, there is no transaction recorded by the not-for-profit organization. There is no transaction recorded by the grantor either. So there's no expense or no revenue until the conditions have been met. And there should not be a consideration of the likelihood of whether the barrier will be overcome. For a donor-imposed condition to exist, a right of return or release must exist. So in an example here, a foundation gives a not-for-profit organization a $400,000 grant to provide specific career training to disabled veterans. The grant requires a not-for-profit to provide training to at least 8,000 disabled veterans during the next fiscal year with specific minimum targets to be met in each quarter. The not-for-profit must meet these targets or the grant agreement specifies that the funding must be returned. So this is a conditional grant. The not-for-profit organization would not record the transaction, the revenue, until those conditions are met, the barriers have been overcome. If the government has transferred the assets, the cash, to the not-for-profit organization prior to the conditions being met, the not-for-profit will record a refundable advance, a liability, until the conditions are met, and then they would be able to recognize the revenue. Because the not-for-profit is not entitled to the contributions until those conditions are met. Just a few examples of what conditions might be included in a governmental grant agreement or any grant agreement really. Specified level of service on this slide, 1,000 meals per week. In the previous example, 8,000 disabled veterans are being trained. So some level of service has to be met. Specific output, students achieving a minimum standardized test score. A lot of times we'll see matching grants. So if the not-for-profit organization is not entitled to the government's grant until they meet some matching level for that grant or for that purpose. And then an outside event, the not-for-profits promise a certain amount once the resource providers net assets reach a specified level. So a lot of times we'll see this with foundations. They might have a condition in their grant agreement that says, once our net assets reach $1 million, we will provide this not-for-profit organization a $10,000 grant. So just a few examples, a couple of notes here. A requirement for an annual audit in accordance with uniform guidance, a single audit is not a barrier or a condition. The requirement to report on how a grant was spent is not a barrier or a condition. So those are considered trivial or administrative stipulations, not barriers to the entitlement of the grant. So if you have an unconditional contribution, the contribution revenue is recognized, but it may have restrictions on its use. Donor imposed restrictions are those that are narrower than the not-for-profit's overall mission. If the not-for-profit has received an unconditional contribution, but it must be spent on a particular purpose or within a specified period of time, then it would be recognized as contributions with donor restrictions. If the not-for-profit ends the fiscal year without incurring expenditures for the intended purpose, or the contribution was for a future period, the statement of financial position would reflect net assets with donor restrictions. So in contrast to donor imposed conditions, donor imposed restrictions limit the use of the contribution, but they do not affect whether or not the recipient is entitled to it. So just a quick example here of what the income statement might look like. You can see there, I've highlighted or boxed in red there, federal and state contracts and grants. Hard to tell whether those are contributions or exchange transactions without any additional detail, but you do see the contributions line there. that has amounts reported under without donor restrictions and with donor restrictions. And then as you move further down the page, when those donor restrictions have been satisfied, the contributions are released from the with donor restrictions column and then added to the without donor restrictions column for expenditure. So I think I'm over time, but that was all I have. And I think we move on to Wes.
All right, perfect. Thank you, Aaron. All right. All right, so thank you, Aaron. So pretty much my presentation is just going to be on a topic you all may already be a little bit familiar with, but in the event where you're not, we're just going to talk real quickly about encumbrances or committed costs. And I'm a technology person, so part of this will be about how to evaluate how you're currently tracking encumbrances and potentially some better ways to track it, or to track them, I should say. So just in the event where you want a definition for this, encumbrances are activities that are booked to your general ledger or accounted for that have been committed to eventually pay for, but you haven't actually received the benefit. Since these occur prior to any receipt of goods or services, encumbered costs or committed costs, whatever you want to call them, you can think of these as purchase orders that you've approved, maybe sent off to your vendors, but you haven't actually received them, received the goods or services for. So you haven't actually booked them to your main set of expenses. And the reason why encumbrances are really useful is, or one of the reasons why they're really useful, is they give you a great way to better control your budget. So a good example of this would be all of your, let's just say if you have $100,000 worth of budget for a particular expense line, and you've already paid $50,000 to date for that particular expense line, and you have $50,000 worth of outstanding POs for that particular line, you want to be able to see that, all right, today I paid for $50,000 and I have $50,000 committed on the way. So since you're already at budget, you're not going to go and submit more requisitions or more orders until you get more budget. And in addition to that, it just gives end reporting users the ability to better see what's all being spent and how your money is being allocated. So what I wanted to get into as part of my presentation here is just a quick overview of how many software systems provide support for them. So chances are, if you're already using this if you're already using encumbrances in your organization, you may have a process of maybe extracting your open POs and calculating how much you have at the end of a month or a quarter or a year, and then just compiling your financials in Excel, which may work fine for some cases, but I always like to talk about ways in which technology can be better used to track things that you're currently doing in Excel. And as part of that, I want to give you a quick workflow example of how a lot of accounting softwares will allow you to track this. And just throwing it out there, in the event where your software doesn't do this well, then we have some software solutions that we could talk about that do. So just to give you an example here, I just have a 3-document workflow here. So when a purchase order gets created, what happens is it's going to debit an encumbered expense account. It's going to get it on your books, and it's going to credit some type of holding account. Usually it's going to be a balance sheet item, and whether it's an asset or a liability is down to personal preference. But the way that you can think about this is this activity happens in what I'm going to call a side reporting book. So it's not like you're putting in a journal entry into your main accrual basis financial books, right? You're going to put it into a separate encumbrance book that you can then decide, do I want to include encumbrances in my financials? Do I want to leave them off? What do you want to do? Right. So when the purchase order gets created, it's going to debit encumbered expense, credit a balance sheet account. And when you process that activity through your system and eventually turn that purchase order into a receiver, When that receiver comes in, now it's no longer an encumbered expense. It's a real expense or a real service or a real good that you've received. So what that does is that reverses out the activity from the purchase order. So your encumbrances book is completely clear, but then it's going to debit an actual expense or potentially an asset. And then it's going to credit an unvouchered receipts liability. So this is going to sit out on your balance sheet as a liability, maybe called unvouchered receipts, and it tells you, hey, this is how much we've received in goods or services that we haven't yet gotten bills for. And then finally, a couple days after the goods have been shipped to you or the services have been provided, then you get your invoice from your vendor. And when you input that into the system, it's going to debit your unvouchered receipts liability to zero that out. And then it's going to credit your accounts payable. So overall in this workflow, again, maybe if your software system already does this and you're not using it, then maybe this is something that you may want to look at doing to help streamline your process. But overall, that's all I had. So I will stop sharing. And I don't have it handy who is up next, but go ahead and take it for whoever's next.
That would be me. Try to share my screen here. So I will talk fast, but I will be talking about unrelated business income. And so if we want to go to the next slide. There are 3 factors that would make an activity unrelated business income and therefore taxable to an otherwise tax exempt organization. The first factor is income from a trade or business. The activity would also be regularly carried on, and it would be not substantially related to the organization's tax exempt purpose. So we do want to keep in mind that the way the organization uses the funds is not relevant. What the IRS is looking at is how the income is generated. So if the organization uses the funds for charitable purposes, that does not matter in looking at whether the activity is UBI and taxable or an exempt activity. And next slide. So trade or business, that would be selling goods or performing services, and there would be an intent to make a profit. You can move to the next slide. And I would encourage people to look at the Form 990T instructions for more detail on these 3 factors, because I'm going to go very quickly. So regularly carried on, we're looking at frequency and whether or not the nonprofit is competing with other for-profit organizations that would be selling the good or performing the service. So if a nonprofit is selling a good for 1 week out of a year, but a similar for-profit sells that good year round, even if the exempt org is selling that good 1 week every single year, that would not be considered regularly carried on because they're not competing with a similar for-profit organization. Okay, next slide. So factor 3, not substantially related. So what we're looking at here is whether the activity contributes to the tax exempt purpose. And then we do have to look at the facts and circumstances, because an activity that's exempt for one organization may be actually taxable unrelated business income for another organization. And that would depend on having different mission statements and reason for having that exempt purpose in the first place. Okay, next slide. So some common UBI examples that we see a lot, a big one is advertising. Advertising is generally going to be UBI. If you're simply mentioning a name and logo, printing a name and logo in a gala fundraiser program, for example, that's probably not UBI. But if there's a call to action to purchase a good or service, or if the sponsor is receiving benefits like tickets to events, that probably is UBI. Gaming is generally going to be UBI, but there are some exceptions. So I'd encourage you to look at those exceptions for that. And then rental income is actually usually not unrelated business income, but we do have to look at a few factors for that. So you can go to the next slide. So you'll see I have rental income here on the exclusions as well. So I'll talk about that. And again, this is all in general terms. There are rules, exceptions to the rules, and then exceptions to the exceptions. So definitely encourage you to reach out to your trusted advisor whenever a tax exempt organization is going into a new revenue stream or a new activity, so they can see whether they're getting into an activity that is going to be taxable or not. So some common exclusions from UBI are royalties, investment income, gain or loss from sale of property, and then rental income. So what we're looking at with rental income is whether there's a debt on the building. So debt financed rental income is likely taxable. And then we're also going to look at whether personal property is being rented and in what proportion to real property, and then whether substantial services beyond a normal landlord-tenant situation is included in the rental agreement. Next slide. Okay, so filing requirements. When an exempt organization has unrelated business income, that is going to be reported on Form 990T, and that is a separate tax return from the Form 990. So you do want to be aware of that and make sure an extension is filed whenever a 990T is going to be required. As Brandy noted earlier, the Form 990 and the Form 990T are required to be electronically filed. That is mandatory now, and the IRS is rejecting paper filed returns and assessing late filing penalty for those. So definitely be aware of that. And when there are rejections, you do have to go through additional steps before you can paper file. Keep in mind, there is a specific deduction of $1,000. So once an activity goes beyond $1,000 of unrelated business taxable income, that's when the organization begins to pay tax on that income. The 990T does have the same due date as Form 990. And Anna is going to talk about the different deadlines in a presentation coming up soon. And then just be aware that there may be state or city tax returns required, and those follow the corporate tax rules. Thanks, Anna. So payment requirements. If an organization does need to make a payment, that is due with the original due date of Form 990T, not the extension. So extensions extend the time to file the tax return, not the time to pay the tax. And then when you do need to make a payment, that's generally done electronically through what we call EFTPS. And just note that the IRS does still use snail mail to send you those PINs. So hopefully you would get that in 5 to 7 days, but just know that you want to enroll ahead of time before the payment is due. And then just keep in mind, estimated tax payments may be required to avoid any underpayment penalties. So Form 990T. I think I'm doing pretty good on time here, actually. So Form 990T, each activity is going to be separately reported on a separate Schedule A. And that goes by the NAICS code. So that's what constitutes a different activity. And just note that you may have income in one activity and loss in another, and an overall loss, but those are no longer overall netted together. So you could still have tax due if you have multiple unrelated business income activities. It looks like a CPE poll just popped up if you want to answer that. Of course, we can deduct expenses on the 990T related to the income that's generating the UBI. And we can also reasonably allocate indirect expenses. We do want to know and document the support for indirect expenses, especially if we're creating large net operating losses. So if you're carrying forward NOLs, just note that the older pre-2018 NOLs can be carried forward 20 years and used against any activity at 100% of taxable income. But those newer losses can only be applied against 80% of taxable income. And they do need to be, the losses need to be netted against the same activity that has income and created that loss in the first place. So older NOLs can go against any activity, but the newer ones have to go against that same activity. And next slide. So other considerations. So we don't really advise clients to totally avoid UBI. We just want to be careful that it doesn't become substantial in comparison to total income. And then again, we always want to document. If we're saying that an activity is excluded from UBI, we need to document why. And then again, if you have indirect expenses that are creating large NOLs, we want to document that. And then just in general, be careful using the volunteer exception. So you may have heard that an activity is exempt if it's substantially performed by unpaid volunteers. We want to use that exception as a last resort because the IRS can argue that free meals or merchandise given to volunteers is considered compensation. So they're no longer considered unpaid volunteers and the activity no longer falls under that exclusion. So just be careful with that volunteer exception and falling back on that. Next slide. So I just wanted to list some resources here. Generally, tax form instructions are not super helpful, but for the Form 990 and 990T, the instructions are pretty good and a good resource for you to look at. And then IRS publication 598 has a lot of good examples about looking at the facts and circumstances for organizations and whether UBI is, whether the activity is taxable UBI or exempt. And then, of course, the IRS website and reaching out to your CPA firm or trusted advisor. Again, whenever you're looking at a new revenue source or going into a new activity. And then I believe that's it for me. I'll take a look if there's any questions in the chat, but I believe Kyle Schaefer is next.
Thanks, Amber. Yep. Share my screen. Alrighty, Kyle Schaefer here. I'm an audit partner on our nonprofit services group. I am also your kind of halfway person. So in about 5 minutes, we'll be halfway through the presentation for the morning. So today we've heard from Aaron covering contributions, those generally related to financial assets. Today, or at least my portion, will cover gifts in kind or non-financial assets. So as far as today goes, here's the few items for our agenda. We'll talk about why in kind is kind of important, an overview of a new accounting standard and when it is applicable and how it impacts your organization. We'll talk on a few different examples, contributed services, as well as donations of inventory and securities. And then we'll kind of wrap things up in a summary. So what we'll also do along the way is share a few examples. All right. Digging in, why gifts in kind are important. So often you might hear gifts in kind or in-kind contributions or just gifts or contributions of non-financial assets. So there is a very large diversity in practice as far as that terminology, generally meaning the same thing. And so when we're thinking of how this relates to contributions, thinking back to Aaron's presentation, this is talking about unconditional contributions, which may or may not have donor imposed restrictions. Some of the most common examples that we would see are contributions of services, fixed assets, use of fixed assets such as your building or equipment. So sometimes when you're thinking of use of fixed assets, that might actually even also be a multi-year promise to give. So just thinking on those things that as far as documents that you have or other things that maybe your program services individuals might be negotiating that as finance folks you're responsible or helping to make sure you're asking questions on. And then the thing that most organizations have probably seen a pretty large influx of over the last couple of years are materials and supplies. As a result of the pandemic, there have been very large increases in donations for personal protective equipment, medical supplies, COVID-19 testing. That's been a lot more prevalent as a result. So we might see some decreases in future years. But those, like I said, just a couple of big items. So then kind of the why do we care? And why is this important? And so from a simplistic standpoint, it really helps you as a nonprofit have an understanding of your true cost of operations. And so without those contributed non-financial assets or gifts in kind, you would have either have had to have gone without those contributed items or purchased them with other organizational resources, or asked for or applied for grants or other contributions to cover. So in addition, there's also grants that might require an in-kind element for a matching component. And generally, when you're thinking of your organization, I kind of alluded to earlier, outside your finance team, there are probably more in-kind contributions than you realize. And I'll share a couple of those examples or some of our relevant client examples. Other items that are helpful is it helps increase the program services standpoint, just making sure all the program expenses are captured. It's also helpful when you, if you do an annual external reporting or maybe a community event to share, all the things that your organization maybe has done from a community impact standpoint or fulfillment of the mission. Just helps capture all the things the organization does. And it also provides another avenue for individuals and organizations to support your organization as well in a non-cash form. So as far as just, folks that are on the finance team, making sure that you're aware of, we had one client as an example on providing education services where a lot of, most of the day-to-day flows right through the finance team. But when we were working on implementing the standard, for a previous year, just kind of working through, talking through folks on the program services side of things, and found out that as part of an annual neighborhood beautification project, they actually were receiving thousands of dollars of things to help out with, their school and to help make their building look a little bit more visible and pretty in the surrounding community with landscaping and other cleanup items. So kind of diving into the first item that I mentioned on the accounting standard update, as with any accounting standard update, that generally does not mean less work, but this is a small accounting standard update in relation to many that we've gone through in recent years. When you think back to the financial statement updates for your organization for the nonprofit reporting, revenue recognition was impactful. And then for many organizations this December and going forward, the lease standard. So this is very small. I would say for most organizations, maybe a couple hours at most, or your finance team, maybe an hour or so of time when you get through these disclosures. So the goal of this accounting standard update is to bring transparency and consistency, which kind of as a result means an increased level of detail in our financials, along with expansion of disclosures. When is this effective? It's effective for fiscal years beginning after June 15th, 2021. So we've implemented this for quite a few organizations that are June 30, 2022 and September year ends. And so a lot of those on the call with December year ends, you'll be the next round. As far as what the disclosure looks like, it is a retrospective disclosure. So if you present comparative financial statements, it'll show for both years presented. But like I said, it's very minimal as far as impact or additional time for your team. And so there are some new reporting, which I'll go into now. So we will share some of this information, but just kind of an overview of the standard. We've got some reporting updates. And so the item that I mentioned first is just a little bit of a change in the presentation. So where Aaron had a chance to kind of talk where we might have had contributions or other explanations that might have been impactful for outside parties, we've recommended these two captions to best capture and delineate between the formerly just called maybe contributions or grants, to refer to them as contributions of cash and other financial assets. And for what I'm talking or covered on now for the in-kind piece, separately breaking out the contributions of non-financial assets. On the disclosure side, there is an option to do a full table or tabular disclosure, but we found kind of the most typical or kind of most easier to read is a mix of a table that discloses or disaggregates those expenses and how they were used for operational activities. So breaking out in further detail than what you would have on the natural expense classification on the statement of activities. From the narrative side, just breaking out the gift in kind valuation techniques. Again, a lot of that's not new to your organization, but requiring enhanced or further disclosures. And then anything from a donor imposed restriction standpoint or overall use of the gift in kind. So a couple examples there. As far as a couple other items before I wrap things up, we do have two other kind of recommended items for you, is just making sure that your finance manual, your policies and procedures cover gifts in kind. So a couple items as far as what should be included in your typical policy statement, as well as your procedures. In addition, your notes to your financial statements and your significant accounting policies should reflect any updates needed. And then we'll skip ahead real quick just to make sure we're on everybody's, be mindful of everyone's time. So as far as just kind of wrapping things up, we want to make sure from a gifts in kind standpoint, from an unconditional contribution, the not-for-profit recipient does have discretion in using or distributing. It has the risks and rewards of ownership. And then, like I mentioned, valuation is a bit challenging. And so making sure that it's in line with your policies for determining the highest and best use of those donated financial assets. So with that, thank you everyone very much. And I will turn it over to Renee, who's up next.
Thanks, Kyle. I'm also gonna just start sharing my screen. And pop. All right. So, oh, another CPE question just popped up. But to keep things moving along, good morning, everyone. I'm Renee. I've been in the Accounting Outsource Solutions Department for a little over 4 years, and I work primarily with our outsourced nonprofit clients. So today I'll be covering program, grant, and fund accounting for nonprofits. So types of grants, quick overview of the types of grants are up there. Keep in mind, this is very top level, and I know other terms are used to describe grants all the time. Starting off, we have federally funded grants. The key factors to recognize with this type of grant is they're usually the most complex and detailed reporting process. In my experience, they tend to require details of expenses applied to the grants through copies of invoices or general ledger detail when submitting grant reports to the grantor. These reports can be identified by their assistance listing number, or previously called a CFDA number. If an organization receives greater than $750,000 in federal funds, they are subject to a single audit. This is an additional level of testing on top of the standard audit an organization may already be having. And then lastly, this type of grant, the money is usually reimbursed back to the organization after expenses are incurred and reported on to the grantor. Next source of funding could be from the state. So reporting requirements for the state usually fall somewhere between the two types I'm discussing on this slide. They typically have some sort of additional invoice template or statement of expenditures report that need to be completed in addition to submitting a profit and loss statement for the organization's accounting software. For this type of funding, again, usually the money is reimbursed back to the organization after the expenses are incurred and reported on. Moving on to foundational grants, these typically have the most relaxed requirements for reporting. In most cases, the grantor will just ask for a simple profit and loss statement for the period being reported on. These types of grants are less structured than the first two that I touched on, and rules and guidelines on what expenses can be used are typically general, leaving room for interpretation for the organization. And these funds are typically received upfront in a lump sum. It's important that when this occurs, that organization's records and this records this revenue to a deferred revenue account for tracking purposes. Then moving on. So steps to easy and successful grant reporting. So you may be wondering what best practices to report on the grant money you received are. On this slide, I have my 10 steps to easy and successful grant reporting. Number one being review the grant agreement between the organization and the grantor. This gives you all the information you need to know related to your grant and creates your roadmap to follow during the grant period. Number 2, make sure you have a clear understanding of the budget that was submitted for the application. Ask yourself if things have already changed since that was submitted, and make sure expenses on the budget are still allowable in the final grant agreement. Number 3, in your accounting software, set up and utilize class tracking for your new grant. Find an unused number or phrase, although numbers do work best, and set that up. And number 4, process your monthly transactions. Use the class that was set up for the grant and tag related expenses you are entering into it. Number 5, enter journal entries for indirect costs if they are needed. Again, refer back to your grant agreement to see how much indirect, if any, can be applied to the grant. Number 6, process and review a profit and loss statement filtered by class set up in number 3. Review this to ensure your grant expenses for the month are all captured to that class and categorized correctly to be applied to the grant. Number 7, taking your total expenses on the profit and loss statement and recognize equal revenue. Your net income for your grant should always be $0. Number 8, print that profit and loss statement for your grantor. Number 9, complete any additionally required reports your grantor may have with the numbers that tie back to your profit and loss. And then number 10, submit your report packet to the grantor via their requested or preferred method. So reviewing your grant agreement, diving into those 10 steps. Number 1, when reviewing, we always want to take a look at the grant amount. Take a look at that assisting listing number, again, previously called a CFDA number. This is only for federally funded grants. Take note of the allowable costs. Some common items I find that aren't allowable are lobbying costs, certain types of fringes or travel costs. Figure out the indirect allowance. Commonly, this is 10% of a grant. However, some grants allow less or more. The grant period, required reporting periods. Do you need to submit a report monthly or quarterly, midway through the grant, or just at the end? And if you do, what date do they need to be submitted by? And then reporting requirements. Does a grantor have a specific invoice template or report or a portal you need to use? Do you have to include copies of bills from your expenses for over a specific dollar amount? And then lastly, I have a tip at the bottom of this slide to take the information I just covered above and create an Excel spreadsheet listing of it all. If you have several grants, this is a huge help and will help you stay organized and can serve as a checklist each month to make sure the reporting of the grants are happening timely and accurately. Additionally, if you have several federally funded grants bringing you across the $750,000 threshold, this will help with your CFA, which is required document for your single audit if you have to have one. Number 2, understanding your grant budget that was submitted during the application. Once you've been awarded the grant, the budget that was submitted during the application, and the narrative that was prepared with it, take time to consider a couple of these key items that may have changed since your original submission. Did you have a staffing change? Perhaps either you lost some employees and are going to be significantly under budget for salaries, or alternatively gain several new employees and that will be working on the grant constantly need to go over budget. Are you aware of some additional expenses that are not allowable to be applied to this grant? Or perhaps cost of materials for the project have gone up, or potential outreach has expanded and expenses need to be adjusted there. Take that final budget for the grant and import it into your accounting software if you're able to. And then find out if the budget is amendable. If it is, what the process is to amend it and how frequently you're able to. And then also, is there any leeway to a certain percentage if you're over, under budget on different categories? Then another tip that I have here is once the budget is imported into your accounting software, for your own internal processes, always run that budget versus actual for the grant period to date to see if you're on track with your expenses. This just helps to recognize if a new budget needs to be put together or if you have vastly underspent and need to start allocating more expenses to the grant before the period's over. Number 3, setting up classes, and number 4, processing your monthly transactions. When the bills are entered for the month, utilize the class that was set up in your accounting system. Here I have 2 screenshots of popular accounting software my clients utilize. The top screenshot is from QuickBooks Online. You can see that the class option is listed and is in this field that you would select the appropriate class for the expense for its related grant. And then the bottom screenshot is from Intact. This screenshot shows a more complicated account code combination where the fund location and department are all being used for grant tracking purposes. So some common journal entries for a reimbursement style grant, like most state and federally funded grants, you will likely do the following: run a profit and loss statement to figure out how much indirect cost you should apply to the grant. Typically, it's a matter of taking total expenses already recorded to the grant and multiplying it by the 10% or whatever percentage is allowable to find how much indirect costs can be applied. And then second entry would be record the applicable revenue to match the total expenses, including the indirect that you just expensed in the last entry. This should be a debit to your grant receivable account and a credit to your revenue account. For foundational grants, or any grant where funding was received up front, it is an identical process for the indirect costs. For the revenue recognition entry, it's similar in the sense that you pull a profit and loss statement and take the total expenses plus any indirect that were entered. And that is your total to recognize for the revenue. In this case, since the money was received up front and is sitting on a deferred revenue account on the organization's balance sheet, so your entry would be a debit to deferred revenue and a credit to revenue. So here I have a screenshot of a profit and loss statement by class. This is just one specific grant. And the main thing I wanted to point out here is that the grant income for the month ending 11/30 and the year to date matched the operating expenses for the month ending 11/30 and the year to date, therefore creating the $0 net income. Then lastly, number 10, submitting your reports to the grantor. Here I have a list of common items I see that are needed for submission. I often see a profit and loss statement, a narrative of some sort, or a granted specific report such as an invoice template or SOE, and support for your monthly transactions, either by copies of bills or for expenses greater than a certain dollar amount, or just a general ledger report. Some common ways to submit your grant could be via email, an online portal such as eGrams, or some grantors have a website with a direct link for you to upload your information. A couple more things to keep in mind is always try to make sure all of your required documents to submit all at once. This limits confusion for the grantor and is a major positive. Always submit your report packet by the deadline. I recently have seen some grantors impose fees for late filings. And above all, the more organized your organization can be, the better they look to the grantor, which helps increase likelihood of repeat funding. That's all I have for today. Anna is up next with tax compliance.
Good morning. My name is Anna Lowe and I work in our tax department. And I'm going to be speaking on filing requirements, deadlines, extensions, and ramifications for non-reporting for different not-for-profit entities. So the Form 990 is an informational tax return that most tax-exempt organizations must file annually. The form provides an overview of the organization's activities, primary accomplishments and purpose, governance, and detailed financial information. The Form 990 is filed so that the IRS can ensure that the organization continues to meet the criteria to qualify for their tax-exempt status year to year. Most tax-exempt organizations that have gross receipts of at least $200,000 or assets worth at least $500,000 must file the Form 990 on an annual basis. Some organizations, such as political organizations, churches, and other religious organizations, are exempt from filing an annual Form 990. And so tax-exempt organizations with less than $200,000 in gross receipts and less than $500,000 in assets can file a Form 990EZ, which is the short form version of Form 990. And then the shortest version of Form 990, the Form 990N, can only be filed by organizations with gross receipts of $50,000 or less. Form 990N is referred to as an e-postcard since it can only be filed online and requires minimal information. So please note a supporting organization described in section 509A3 is required to file a Form 990 or 990Z if applicable, but cannot file the Form 990N unless it qualifies as one of the following. So it would have to be an integrated auxiliary of a church, the exclusively religious activities of a religious order, or an organization, the gross receipts of which are not more than $5,000 that supports a 501c3 religious organization. And then private foundations must file a Form 990-PF regardless of their financial status. The state of Michigan requires that most 501c3 organizations that solicit or receive contributions in excess of $25,000 register with the Attorney General Charitable Trust Division. So information on who may qualify for exemption will be found on the webpage on the next slide. But when the charitable trust section registers a charity, that means that the charity submitted all information required under the Charitable Organizations and Solicitations Act, including a complete financial statement, which is typically the IRS Form 990, a list of their officers and directors, an indication of the methods of solicitation, contracts with professional fundraisers, and a statement of the organization's purpose. For current submissions, charities that receive over $300,000 in contributions during the reported year must also provide financial statements reviewed by a CPA, while charities that receive over $550,000 in contributions during the reported year must provide audited financial statements. Governmental grants reported on Form 990, Part 8, Line 1E do not count towards these thresholds listed above, but the net fundraising income reported on Form 990, Part 8, Line 8C and 9C do count towards those contribution thresholds. These thresholds are adjusted periodically for inflation and should be monitored. The State of Michigan AG office posts the basic information of their active registrants at the website you see on the screen. However, the existence of a registration does not mean that the Attorney General endorses a charity or vouches for the accuracy of the submitted application of financial information. All of the AG fillable forms, including the solicitation form, renewal solicitation form, and the application for exemption, can be found at the link on your screen. Please note, though, that each state has their own rules on license to solicit registrations. So if there is fundraising activity going on in other states, it is important to look into those states' rules as well. Any political organizations, typically a 527 PAC, with taxable income exceeding $100 for the taxable year, must file a Form 1120 POL. Generally, the organization's investment income is going to be the only taxable income. On this return, the organization may not deduct salaries, rents, and other expenses it incurs for its political campaign activity reported on Form 1120 POL, but only those expenses that are directly related to earning that taxable income. For example, the organization may not deduct the salaries of its campaign director. If, however, the organization hires a broker to manage its stock portfolio, it can deduct that expense from the taxable dividend and capital gain income derived. Other types of nonprofits may be required to file a Form 1120 POL if engaging in a political activity. And then an exempt organization that has $1,000 or more of gross income from unrelated businesses must file the Form 990-T. So unrelated business income is generally income from a trade or business regularly carried on that is not substantial related to the charitable, educational, or other purpose that is the basis of the organization's exempt. If you are looking for more information on lobbying and PAC filings, as well as UBI reporting, please reference the materials presented earlier by Brandy and Amber. And then it looks like a CPE pop-up just popped up on the screen if you want to take a second to complete that. And then Form 990 is going to be due on the 15th day of the 5th month following the end of the organization's taxable year. For calendar year end filers, this is May 15. If a due date falls on a Saturday, Sunday, or federal holiday, the due date is delayed until the next business day. So the table above does not reflect that additional date. And then the due date for a 990 end return is going to be the initial due date above, as 990 ends cannot be extended. Form 1120 POL is going to be due the 15th day of the 4th month following the end of the organization's taxable year. Form 990, 990 EZ, 990 PF, 990 T, and the 1120 POL can all be extended by 6 months by filing a Form 8868. the 990N cannot be extended. However, while the 990N cannot be extended, there are no penalties for late filing a return, so long as the time frame since the most recent filing does not exceed 3 fiscal years. It is also important to note that while the 990T return is typically prepared alongside either a Form 990 or 990EZ, it requires its own separate extension be filed. The Michigan license to solicit AG registration may also be extended. Extensions can be requested by selecting the box on the annual renewal application or may be requested via email or letter prior to the expiration of the registration. If an organization with gross receipts under $1,094,000 fails to file their required return by the due date, including any extensions of time, it may pay a penalty of $20 a day for each day the return is late. The same penalty applies if the organization does not give all the information required on the return or does not give the correct information. For organizations with gross receipts over this threshold, the penalty increases to $105 a day with a maximum penalty of $54,500. If the organizations are subject to these penalties, the IRS may specify a date by which the return of the correct information must be filed. If the return is not filed by that date, an individual within the organization who fails to comply may be charged a penalty of $10 a day. The maximum penalty for all individuals with failures with respect to a return shall not exceed $5,000. And again, each of these thresholds increase periodically for inflation and should be monitored. And penalties for failure to file may be abated if the organization has reasonable cause for the failure to file timely, completely, or accurately. The Michigan license to solicit registration requires organizations to report on their most recently completed financial accounting period. So if your contributions are over the $300,000 threshold we talked about earlier, you may need audited or reviewed financial statements. If you meet this threshold but did not have an audit or review completed, you may request a one-time audit waiver for the financial period. This is a get out of jail free card of sorts and may only be used once during the life of the organization. Its use must be tracked by the organization so that they do not attempt to use it a second time. Please also note that there are neither filing fees nor late filing penalties for this AG registration. And then an organization that fails to file the required return for 3 consecutive tax years will automatically lose its tax exempt status. An organization whose tax exempt status is revoked for failing to file Form 990 may apply to obtain reinstatement of that status by filing Form 1023 or 1024 as applicable and paying the required user fees. If upon application for reinstatement of tax status, an organization could show to the satisfaction of the IRS reasonable cause for the failure to file the Form 990, the organization's tax exempt status may, in the discretion of the IRS, be retroactively reinstated to the date of revocation. Organizations should do everything they can to ensure their tax exempt status is not revoked due to a failure to file. Resubmission of the 1023 or 1024 application is cumbersome, costly, and does not guarantee reinstatement. So if you find yourself in a situation where you need Form 1023 or 1024 prepared and filed, please reach out to a member of the Maner team as we can assist with this. And now we are going to transition to Sarah to go over trends in not-for-profit needs.
Thank you so much, Anna. That was wonderful. And thank you to everybody so far. I'll just remind people, if you have any questions, we do anticipate having some time at the end. So please type them in the chat and we'll have all the presenters come back and we'll be able to facilitate that as the questions come in. I know I've gotten some kind of on the side in the chat, so we'll have some that we already anticipate going over as well. So as Anna said, we're talking about trends in the nonprofit area, the needs that we're seeing in our clients, the goals that may be shifting or changing within the organization. What I'll talk about is really big picture organization-wide, what we're seeing, and some considerations, some things that you may need to think about in your nonprofit or when you're working with clients or when you're talking to your peers. We'll look at some things on the revenue or the profit side of things, and then on the expenditure side, some trends and consistent themes that we're seeing in the nonprofit area. So the first big picture category I've got here is organization. So over the past 3 years, we know that the world was completely flipped upside down. We know that organizations, nonprofits, for-profits alike, really are looking at all sorts of things, all sorts of changes. One of the things that we're hearing a lot about is outsourcing versus internal staffing. This is anywhere from HR resources, IT resources, accounting resources, clearly. People are really trying to do, I think, a more thoughtful job, organizations a more thoughtful job about what it is that they're needing and what it is that they're looking for, partly because of the talent war that we've got going on that everybody's impacted by. I do think that we're going to see a shift in the coming months to make that talent war not quite so painful, but we certainly have been in the middle of it. So I have a lot of different clients, and I know others on the other panelists do as well, that they're really trying to look at the cost benefit. So it's not just a consideration of outsource versus internal staffing. There's all sorts of factors that we recommend and we help organizations kind of work through or talk through. One is how quickly you can get somebody up to speed. Retention, what your track record is for employee retention. Clearly, you're looking at the cost benefit, the dollars, not just the dollars of the gross salary, but any benefits, training, how frequently you're going to have to train. The other thing that we're seeing that's really truly related to the outsource versus internal staffing is more concise job descriptions. I think in the nonprofit world, we see maybe more than the for-profit world, but definitely in the nonprofit world, people just wear a lot of hats because we work in nonprofits, many people, because of the mission, because of the passion for the cause. Because of that, you're always ready to say, yes, I'll do that. Well, I'll put on this other hat. Well, I'll do this also. And I think in this day and age, the feedback that we get from team members, the feedback, we work with a lot of HR companies as well, and we just kind of pick their brain as to what they're seeing. The feedback that they're also getting is that the team members out there, they want to know what it is they're supposed to do so that they can do it well. I think that that's going to continue to be top priority for organizations. We're going to have to really not only look at what the job description is, but once we've got our concise job description down, we've got to make sure that we've got the right people in the right seat. And that is kind of an organizational shuffling, if you will. We know, most organizations know, you've got great people. So it's not a getting rid of any individual or changing anything like that. It's really just making sure that we've got the people in the seats that they can excel and that they can move the organization's mission forward. The other thing that we're seeing, and again, this is just really kind of global conversations, is a tweak or a change in the discussion about accountability and goals and strategic priorities. We've definitely seen more nonprofits in the last year and a half, 2 years, looking at shorter term goals, SMART goals, so that they are absolutely measurable, that they can hold people accountable, that they've got a timeline, and really tying those goals, to the strategic priorities of the organization. I've seen a lot of organizations in the past where they've got the board approved strategic plan, and then there's smaller goals that all the team members have. There's not a direct line to that strategic plan. So we're really seeing people take another look. We've got a lot of organizations that are looking, I don't know if you've heard of the entrepreneurial operating system. Organizations, nonprofits alike, are really looking at that structure and saying, you know, we run like a business. We're not a for-profit organization, but at the end of the day, we want to make sure that we are making a profit so that we can invest in our mission for future years, so that we can be sustainable and we can scale with whatever the programs are that we're trying to develop. So we definitely, again, have seen organizations moving and sometimes getting assistance, like project management assistance, to get some of these programs up and running or initiatives up and running, but moving from having all of their team members or their leadership team having annual goals to something that they can kind of digest in smaller packages, all rolling up to the annual goal and all rolling up to that 3 to 5 year strategic plan that the organization has. The other thing that we've seen is I'm going to say culture shift, but I think it's a culture alignment. So when things are great, they're great. And it's easy to kind of not pay attention to some unique or some specific areas of concern. When things are bad, everything seems really, really, really bad. So I think we've seen a lot of nonprofits, a lot of organizations kind of taken a step back and say, okay, what is our why? Ultimately, why are we established? Why are we working together to this end goal? And from that, we can make sure that we remind everyone, this is why we're doing what we're doing. The other thing that I've seen in a lot of organizations is because of that talent war, we're having to just make sure, again, not that you're changing your culture necessarily, but you're re-emphasizing what your culture is, what your values are. You're making sure that you operate values first so that you can have a leg up in that talent war that we're all seeing right now. The other thing is really culture, again, not necessarily shift, but we're seeing a lot of organizations consider hybrid versus remote versus in-person workstations. How are we making sure that our culture of collaboration and working together and team development, how do we maintain that in this hybrid or remote world? It's really, really interesting. I think there's a lot of opportunities out there, and those are really the big things that our client base is looking at. There is a CPE question up, so if you need that CPE, please remember to just click on that poll. The next thing that we're looking at is revenue streams. So clearly, Amber earlier talked about considerations for unrelated business income. We're seeing a lot of organizations evaluate what other revenue streams could we have that isn't dues for organizations that are normally membership based. So we've had a lot of organizations in the last 2 years in particular really take a step back and say, what is the value of our membership? Why do people join? It isn't necessarily just because they need to be a member. Some clearly have credentialing that they need to be a member. But really, what is the why? What other value are we providing for our membership? And people are brainstorming. What else could we do? I think that it's really important to look at that unrelated business income so you get a full picture and you really can evaluate what the ramifications are of these new revenue streams. So that's something that we're seeing a lot of. Another thing that we're looking at traditionally, pre-pandemic, we looked at event registrations, and that was for a lot of organizations, that was their bread and butter. They had 1 to 4 to 12 different events a year, and that's where they generated their revenue from either registrations, sponsorships, whatever it might be. We're seeing during the pandemic, there were so many competing areas for ways that charitable organizations were reaching out to potential donors. If you're an education-based organization, there's a lot of free or different types of continuing education that organizations were offering. So we're really looking at people kind of shifting, or not to use an overused word, but pivot their organization to say, okay, what is it that we provide that's a unique thing for our membership, and how do we maybe do this? Oftentimes the event registration went down. There's a lot of organizations right now that are saying, do we really think that's going to go back up to where it was and stay there from the 2019 levels, or do we think it's going to be somewhere in the middle? And if that's the case, how do we tweak our model? We've seen a lot of organizations, instead of just a static event registration sort of a model, whether it's for an educational seminar or something like that, they're going to a subscription series. So if they have virtual sessions that they're doing, it's more blending the dues and a subscription for all of these educational opportunities that organizations have, or ways to engage, not just education, but just different ways to engage. A subscription basis instead of, again, static events. The other thing that we're seeing, and we've talked about this a lot today, there's all sorts of training on grant. There is so much money out there, and we've seen a lot of organizations that have pivoted because they didn't have grant opportunities in the past, and now they do. Some of the things that we're seeing is organizations, they're applying for these grants, but then it's a rude awakening after it's actually awarded how much work goes into the administrative side and the reporting side of things. So that's where we would definitely caution organizations to make sure that it's not just the program folks that are taking a look at the opportunities for grant revenue, but it's also the leadership team, the finance team, to make sure that the infrastructure is in place to be able to report effectively, like we talked about earlier. From the expenditure side, again, we talked a little bit about the talent war and the need for organizations to look at outsourcing various different things. So then you're comparing on your budget, for example, whether you've got contracted services or you have payroll and related, that we are seeing kind of a shift in some of those line items or those rows on the budget. Definitely seeing organizations take a look at their occupancy, what that looks like, if there's structural things that they need to change in order to make their space, their physical footprint, a bit more collaborative. We're seeing that happen so that organizations can encourage their team members to come back, or they're really just looking, okay, we know we need an office, we need a physical location, but what's the goal there? Why do we need it? And how do we change our infrastructure to make sure that that is what we're fulfilling? And clearly, we're seeing a lot of people just shift what their technology needs are. That actually goes back to some of the investments that we talked about earlier. People are saying, well, I am going to spend less in occupancy because I know I need more in technology. Or from the revenue side of things, in the past, we've done in-person events. We need to invest in some learning management systems, or at least consider what that looks like. Because in the long term, our strategy, our mission, our vision of the organization, we see that we're providing these resources, we're providing a place for our memberships or our stakeholders to gather together. That may not be in person now. So there's just a lot of different considerations and things that we see organizations doing. The last thing that I'll touch on that we're seeing a lot of trends and changes is in the area of reporting. There are various different reasons. Clearly, the reporting would change because operations have changed, because you have different, you don't have the event reports that you're reporting on. You don't have just the same types of things that you need details on. Some of the rows, some of the chart of accounts, some of the structure of the standard financial reports have changed. But we've also seen changing because of board member engagement. We've seen a shift to try to engage the board members and focus the board members on the right things, how to be a great board member. It might not be focusing in on what miscellaneous expense, why that went up by $200. And I say that in jest, but I'm quite certain most people who, if you're a CFO, a controller, a finance person that's presented to the board, it's really easy to focus for board members to focus in on a 200% change in miscellaneous expense, but maybe it started with a $100 balance. So how do we help change our reporting so it's really reporting the right things to the right people? The other thing that we're seeing is increased budget adjustments or amendments because of the change in the revenue makeup, because we've got more grant opportunities and things like that. We're definitely encouraging our clients to make sure that they go back to the board with these budget amendments. They go back and it's not just a separate thing show kind of on the side of their traditional financial reports, but that we do this because it's really easy to say to a board, well, that difference or that variance is because of this new grant. Well, if that's the same exact answer every single month, amend your budget so that you can still use it as a tool if there are anomalies, pardon me. So really, there's a lot of things going on. There's a lot of trends. That is all I've got for the trend. For the trends in nonprofits that we're seeing. And I do have the next presentation. We are going to cover our contributions. So we already went over the big picture contribution accounting, what the standards are, why they're needed. So this is really an expansion of that, and we will be able to go over, given all of those things that we know, given how we know now that we're recognizing revenue, when we look at conditions of different contributions that we're getting in, how do we record them? When we're really in the accounting records, how do we prepare for the auditors to come in, and how do we make sure that we're tracking that in the most streamlined and effective way? Again, this is just the big picture to align our expectations, gone over earlier in lots of trainings that we could go over on this topic specifically. But you've now got the need the increase need to make sure that you're identifying any contributions, any revenue that comes in the door that has some sort of a condition or a restriction. And how do we do that in a reasonable, streamlined way? So the first thing, clearly, separate Excel spreadsheets. This is the first method, not the best method necessarily, but it is the first method that we'll take a look at. So often organizations will record all of the contributions in one account, general, just contributions. And on that, we will take a look at, in the general ledger, it will be all of the individual contributions, but it's just lumped together in one thing. When we get to year end, as was mentioned earlier, and as we talked about with conditions and different donor restrictions that they have on different contributions, we need to make sure that we know what the condition is, whether it's time, whether it's because they want it for a specific use. And we need to be able to monitor when that is released or when we have met that condition. So, as I said here, all contributions oftentimes are recorded in the general contribution revenue account. But in order to really prepare for year end and prepare for how that needs to be reported on annual financial statements, if you keep an Excel spreadsheet, I rarely recommend an extra Excel spreadsheet, but if you're already recording them here, it is necessary. So even if you export that detail on a monthly basis, whatever's in contributions, anything that is tagged with a restriction or a donor restriction or a condition, anything like that, if we just maintain them in a database throughout the year, it's much, much easier for you to go through at the end of the year and provide that to the auditors or provide that to the whoever's preparing your year-end financial statements in order to make sure that all of those things are recorded properly and tracked. The other thing to keep in mind if you are maintaining some of these Excel spreadsheets is that's going to be something that isn't done in 1 year necessarily. Oftentimes, especially with year-end appeals for anything, you've got contributions that are going to have a condition that hasn't been met by year end. So they're going to linger on. This Excel spreadsheet will allow you, that's outside of your accounting system, will allow you to carry that over year after year after year. The next method that we have is using your chart of accounts. So this is a step up. In the first method, as I talked about, we've got just one general ledger account that's just for contributions. We don't want to change that. It's not significant, it has been determined to not cause us to change our chart of accounts. The next method is using your chart of accounts. So you have specific account structures identifying the restriction or the condition. If it's a donor restriction, maybe it is for specific capital improvements and you're trying to track that month by month so you can see that in your ledger. The group of expenditure accounts, oftentimes we also see that if it is for a related and expendable sort of a restriction. Example, again, you've got a donor that says, I'm giving you funds for this capital project or for new computers or whatever whatever condition they put on there. You can show that in your expenses in a separate chart of account, general ledger account. The challenge with this, and I definitely see it, but your chart of accounts grows astronomically if you start to get additional conditions, additional restrictions, reasons on all of your contributions. So oftentimes an Excel spreadsheet is still needed because we need to make sure that we can carry that over year after year after year. I will say that this reduces the interim reporting and the interim busy work of maintaining an Excel spreadsheet because you can at least see it in your chart of accounts, what your conditions are, what your donor restrictions might be. The last one that we're going to take a look at is the class or dimension methods. And we went over earlier today, Renee did a great job of highlighting how we can use classifications, dimensions, different things within our accounting system. Because again, all of us are, because of the talent war that we talked about earlier and because of other things, we don't have extra time in our day to be able to create these Excel spreadsheets. We really need to be putting more pressure on our accounting software to do it for us. So in similar fashion to how we would record categories for different grants, we can do that for different types of contributions, different things that we're collecting contributions for in order to track the revenue side as well as the expenditure side. Again, there's going to be an entry at the end of the year because you're not going to recognize revenue for everything if the condition hasn't been met. You're not going to be able to expend and utilize all of that and just include it in unrestricted net assets. But this is an internal record keeping mechanism that you can clearly see and provide auditors or provide your year-end financial preparation team. You can provide that to them so they can clearly see, oh, I see what the ending balance should be. The one caveat that might make you still need to have that Excel spreadsheet is if your category or your dimension, your class, whatever accounting software you're utilizing, but if that isn't tied to rolling into a donor restricted or a conditional net asset account, you'll still probably have to have a separate Excel spreadsheet, but it's an annual thing as opposed to something that you're doing on an interim basis. The other thing that I'll say just briefly on contributions and how you're doing that on an internal basis, it's really critical in order to report to management, in order for your boards to do their due diligence and their job to report these things to the board so they don't have surprises, so they don't wonder what these changes are between the interim reports that they see in the year-end financial reports. The more you over communicate to them, the better, in my opinion. And I say this not as an accountant doing the financials, but as a board member. It's very, very beneficial for me to see, what do we have left to use because it's been sitting there from a donor for 10 years. How do we know what that is? Not something I recommend reporting to a board on a monthly basis, even a quarterly basis, but definitely when you're going into your budget process, what do we have out there that we haven't met, whether it's a condition or a donor restriction that they've put on something? It's definitely something that you should take a look at. I know we are running short on time, so I am actually going to stop sharing my screen and ask all of the panelists to come back and share their video. I'll remind everybody one more time, if you have any questions, please type them in the chat. I know we've gotten some, so I'm happy to facilitate a few things. We have gone over our 90 minutes, 9 topics in 90 minutes. So I think that we have covered your CPE requirements, but our team is definitely dedicated to staying on and answering any questions that come in. All right, so I will go ahead with the first question that we received earlier. And what I've got is and this is for Amber, how are in-kind contributions reflected on the 990?
Sure, that's a good question. So in-kind reporting on the 990 will depend on whether it's goods or services. So a lot of times with in-kind services, we'll see that revenue and expenses net to zero. So in that case, it wouldn't actually be reported on the 990. If they don't net to zero, we would see what we call a Schedule D reconciling item. And for goods, that would be reported on page 9, statement of revenue. And there could also be a Schedule M filing requirement, depending on whether art or historical treasures are donated or if goods exceed $25,000. Brandy, did I miss anything on that?
I think you got it all. Yep.
Okay.
So it's just a little different than the financial statement reporting.
Mhm.
Perfect. The next question that we got in, Wes, I think is best posed to you. Clearly, Wes, you're in our technology department. You do a lot of, you're one that has many, many different hats. One of the questions came in, we hear a lot about integration, about linking, about things like that. What are some triggers that you hear, when should they start asking more questions and organizations start asking more questions about these things? And what would the next step be?
Yeah, thank you, Sarah. So one of the things to keep an eye out for, especially when we're talking about keywords and triggers, would be things like data entry, right? It's whenever anyone mentions like I do a lot of data entry or we spend a good amount of time doing data entry every month. Usually whenever you're doing some type of data entry, it almost always is something that can be automated with a bit of software or even just like a scheduled task. right? So let's just use migrating sales activity from, or I should say, maybe contribution or membership activity from one database to another. If you spend even a couple hours a week migrating that data over to get your revenues over, you can almost always automate that with a bit of software. And 2 hours a week doesn't sound like a ton, but when you multiply that by 52 weeks a year over a bunch of years, that adds up really quickly. And those are 2 hours worth of time that are better. You're better off spending in other areas to help better the ability to execute on your mission and things like that.
Perfect. Thank you so much, Wes. The last question, and then I'll give all the panelists just a minute to give any final words of wisdom. The last question I've got is for Renee. So we talked about the importance when you're doing grant reporting internally and you're reporting to your funders on having the revenues equal the expenses. So how do you do that with indirect cost? Can you just go over that again? Because clearly it's something you're reimbursed for, but it's not something that I'm not writing a check to somebody to be able to put that in my expenditures. How do you address that?
Yeah, so typically it's a journal entry based on, your expenses for the month and the allowable indirect costs. And in my experience, clients may have like a specific indirect, expense account, or they might have their accounts that are related to like admin, which they classify as their indirect. So they're hitting those types of expense accounts. And that is adding to your expenses, which therefore is adding to the income and the amount that you're being reimbursed for. Sarah, I don't know if you have anything that you'd like to add in that from your experience, but that's what I've encountered.
So I think that was it for today. And we appreciate everybody coming. If you do have follow-up questions, please, send us an email. We have a follow-up slide. I don't know if Sarah can share that or not, but if you have any follow-up questions, we are happy to take them after the fact. We also have an event coming up in January that we will have some information coming out on, and it's going to be more of like an HR roundtable. So we would, if you're interested in that, then please keep an eye out for your email. And that's it for our end.
Thank you to all of our presenters today. We are going to be sending out an email on Thursday, December 15th, with the recording of the presentation, and all of the presenters' contact information will be in the email as well. So if you have any additional questions, you can feel free to reach out. I think that wraps it up. So thank you all and have a great rest of your day.